Hello financial fans, welcome back to another stock analysis. Today we'll be covering Mondelez International, stock ticker MDLZ. Mondelez is a foods and snacks manufacturer, owning some of the largest brands of things like chocolate and snacks in the world. These are brands like Oreos, Milka, Toblerone, and Belvita. Currently, they have a $91.8 billion market cap, and in 2021 they generated a revenue of $28.7 billion. The dividend yield is currently 2.26%. In 2012, they split away from the Kraft Foods firm and became Mondelez International, with its main portfolio including the foods and snacks. 39% of their revenue is generated in Europe, 29% in North America, 10% in Latin America, and the remaining 22% in AMEA, which is Africa, Middle East, and Asia. To evaluate the company, we'll be using a margin of safety and a random valuation. This margin of safety will be based on financial ratios, the health, and the growth of the company. Our standard margin of safety will be 25% and can either increase or decrease based on the ratios that we'll look at in just a moment. The amount that we increase or decrease the margin of safety will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we'll be using 3 colors in our scale, bright red will mean 5% increase, orange will once again be no change, and light green, or bright green, will mean a 5% deduction from our margin of safety. The first ratios that we're going to look at are the EBIT growth and the margin growth. As you can see, the EBIT has gone down from going from 2013 to 2016, but it has managed to regain itself from 2016 to 2021. The average growth during this period was 2.3%, so no change in our margin of safety. The margin, however, has steadily been increasing over these years, and the average growth in margin was 4.5%. This means a 5% deduction from our margin of safety. The next two ratios are the dividend growth and the payout ratio. We'll be looking at the dividends going from 2013 to 2021, since that is when they split apart from Kraft Foods. The dividend has gone from 56 cents a share in 2013 yearly, all the way to $1.40 a share annually in 2021. The average growth in dividends during this period was 12.2%, meaning a 10% deduction from a margin of safety. The payout ratio is sitting at a solid 43.8%, which means no change in our margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of its debts. Doing this, we get a debt to EBITDA ratio of 269%, meaning no change in our margin of safety. The return on invested capital for Mondelez is currently 4.94%, meaning no change in our margin of safety once again. Let's go look at the valuation models next to determine the intrinsic value of Mondelez. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow all the way from 2012 to 2021. The average free cash flow growth during this period was 14.44%. And since we're calculating the lifetime expected growth of the free cash flow, I've gone with 70% of this average growth, seeing as the company has shown solid increases in their free cash flow. This leaves us with a lifetime expected growth of 10.11%. With this percentage, we can determine the future free cash flow of Mondelez and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. Summing up all of the free cash flow, we get a sum of free cash flow of just over $100 billion. To get an equity value, we have to add the cash and equivalents and subtract the debt. Then we're left with an equity value of just under $84 billion. The last thing we have to do to get our discounted cash flow price per share, is divide the equity value by the shares outstanding. Then we get a discounted cash flow price per share of $61.15. With the current price of $67.24, this leaves us with a downside of $6.09, which is just over a 9% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payments going from 4 years ago to the current year. The average growth in dividends during this time was 12.36%. So once again, calculating the lifetime expected growth in these dividends, I've gone with 50% of the average growth rate, which is 6.18%. We'll also once again be using a discount rate of 8.5% in this calculation. And during the calculation, we get a discounted dividend model price per share of $64.06. With the current price of $67.24, we're left with a downside of $3.18, which is almost a 5% downside. The final valuation model that we'll be using is the multiple valuation. By looking at companies that do similar business to Mondelez, looking at their stock price and earnings per share, we can determine an average PE ratio in the industry that Mondelez operates in. In this case, the average PE in this industry is 27.15. All that's left for us to do to get our fair value is multiply it by the earnings per share that Mondelez generates. Out of this, we get a fair value of $61.09. And with once again the current price of $67.24, out of this model we get a downside of $6.15, which is just over a 9% downside. Let's go look at the final overview of our valuation model next. Looking at our final overview of our valuation model, we've imported the discounted cash flow, the discounted dividend, and the multiple valuation price per share. Out of this we get an average price per share of $62.10. Without applying our margin of safety that we've calculated, we get a downside of 7.64%. But we have calculated our margin of safety earlier by using a standard margin of safety of 25%, deducting 5% from the margin growth, and deducting 10% from the dividend growth, leaving us with a margin of safety of 10%. When we are applying this, we're left with a fair value of $55.89. With the current price of $67.24, we're left with a downside of 16.88%. So, looking at our calculations, it's currently a sell. If there's any other companies that you would like to see on this channel, please let me know in the comments. And thanks for watching.